Hello traders, Gary Wagner here. It is approximately 12 noon in Honolulu, Hawaii, Wednesday the 24th day of August, and this is the daily report for gold. What a day we have seen in the gold market. Second day, this correction continues. It has picked up some steam. The market has been moving lower, and we are currently trading off about $70 plus at $17.50 per ounce. On today's report, we're going to cover two basic topics. The first topic, of course, is have we in fact left that fifth wave? The answer is going to be quite obvious. It is my belief at this point that the highs that we recently saw as this market traded up past $1,900 were in fact absolutely the conclusion of a major fifth and an intermediate fifth wave. That will take us to our second question. The second question we need to ask is this a key reversal, or is this simply a corrective component within a bullish phase? And I will attempt to answer that all on today's report. Traders, I think you're going to find that my answers are probably quite obvious. The first thing is, did we conclude our fifth wave? Well, without a doubt, we have to say yes. What I've done is I've pulled up our 360-minute chart. On this 360-minute chart, you can see this is the master chart we use for our Elliott wave. In dark blue, this, of course, is our major count. And then in the red or light red is our minor count. What is quite clear is as follows. As this marketplace came up, we had our current high, which was trading just above 1900. When we take a look at it in detail, and I'm going to try and blow that up for you because I think you're going to find it to have formed a very, very interesting pattern. It's one that I have very rarely seen within the marketplace itself, and that is you get this cap or this high, it's absolutely being signaled by a doji. And if you look at it in detail, now realize this is a 360-minute chart. You notice we have, as the market moved up, we have the green candle, then the doji, then the red candle. That is the Three River Evening formation. But here's what I found genuinely interesting as I looked at the chart. It is both preceded and capped with yet another doji. So you have what's known as, if you didn't have this red and green candle, you would have in essence what is called a tri-star formation. Tri-star formation is extremely rare. We don't have a pure pattern today because of the fact that you have this red and green candle. However, if you remove those, you've got that tri-star. It is very indicative of a top formation. Now, that being said, the question that we need to obviously look at now in detail is, first, where should this corrective wave go? So the first thing that we want to take a look at is the fact that we are currently in our A wave, our A corrective wave. Now, in a typical, and this is not a typical market, but in a typical correction, we would take a look at this entire move. This move would be from 1480 up to our record high, which would be about 1916, and we would run a Fibonacci retracement from that chart alone. We would then look at the 23% level and the 38% level as our starting points. To do that, I want to bring up this weekly chart here because I've already put those numbers in for us, and I think you're going to find something interesting. And that is that it obviously went right through the 23% level. There can be no doubt about that. That's 1813. The next level is going to be 1749, and as you can see, as we are talking, that market is breaking below that, currently trading at 1743. So it's about $6 below. But here's the key. It is within this area right now, and so it tells me that if we received, and that's a big if we receive some sort of confirmation here, this might in fact be the point that we bounce or end the A wave itself and then look at a B wave. If in fact the market continues to trade lower and does not find support, the next logical level has to be the 50% retracement of this entire move. 50% retracement is roughly at the 1700 mark. As you can see from this line here, drawn very, very lightly, you have 1697.51. That would be a 50% retracement. 50% retracement is rather steep, and the fact that we're a little bit below that tells me that we certainly have not gotten any confirmation whatsoever that the marketplace itself has found support, but this is the logical place in which we should begin to look for it. Now, I'm going to take that a step further. Traders, this isn't what we're acting upon because we need to find definitive confirmation that we are in fact at the conclusion of A. But let's take a stretch, and let's say, for example, that we do end up labeling this right here our A wave and the conclusion of it because it's gone to a 38% level. Where would we expect B to go? B is actually a fairly easy wave to calculate because in straightforward Elliott wave terminology, what you look for is you look for that bounce, which is simply what B is going to be because it's going to be a bounce before we hit a final corrective wave, but you would look for a bounce either to approximately 50% of this move down or a move to 75%, and you would probably get the market bouncing somewhere in between these 2 points. These 2 points being a 50 and 75% retracement or backfill, let's say, of the recent move down. Once we had that, we would get a final C corrective wave, and C is going to be a more tricky wave to discern because in a flat correction, the market would simply go back to the conclusion of A, and in a traditional corrective ABC, you would get a new low, the low being below whatever low we hit here, and that low is currently about 1744. So traders, what are we looking for? Well, we've obviously hit a correction, but the underlying point that I really believe firmly is that what we are witnessing is a brutal round of profit taking, but it is a round of profit taking. In other words, I absolutely am convinced that we are still within a bullish trend. We are still within a long-term Super Bull cycle. That Super Bull cycle is 13 years in length. But this market simply overheated. It went up much too quick, much too fast, and therefore we are seeing the kind of corrections that are not typical of a market, but traders, this is no typical gold market. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.
Many sights to see, and when I look in my window, so many different people to be, that it's strange